In today's video, we will be discussing the difference between fixed costs and variable costs. First, let's define the term cost. Costs refer to any expense that a business incurs during the manufacturing or production process. Put simply, it is the value of money companies spend on purchasing and selling items. Businesses incur two main types of costs when producing their products: fixed costs and variable costs. A fixed cost is any expense that remains the same no matter how much your company produces. These costs are normally independent of our company's specific business activities and include things like rent, property tax, insurance, and depreciation. Because fixed costs remain the same, regardless of whether your product is being produced or not, your company cannot avoid fixed costs. Let's walk through an example. Suppose an ice cream company named Sweet Scoops has fixed cost of $1,000 per month to rent the machine it uses to produce large batches of ice cream. If Sweet Scoops does not produce any ice cream for the month, it still needs to pay $1,000 to rent the machine. But even if Sweet Scoops produces 1 million pints of ice cream, its fixed cost remains the same. On the other hand, a variable cost is an expense that changes based on how much a company produces and sells. This means that variable costs increase as production rises and decreases as production falls. For packaged food, variable costs include three buckets: cost of goods sold, cost of fulfillment, and cost of sales. Cost of goods sold covers all the costs you incur to manufacture finished goods. These include ingredients, labor, inbound freight, inventory adjustments, and shrinkage. Cost of fulfillment covers all the costs of moving finished goods to the customer. These include shipping to customers, outbound freight, warehouse, and handling costs. Cost of sales are the costs related to selling the finished product. These include trade spend, marketing and paid ads, demos, trade shows, third party fees, and allowances. Variable costs fluctuate based on the amount you produce or consume. Think of a bill at a restaurant. The more food you order, the more expensive the final bill will be. When you're looking at your variable cost expenses for launching a packaged product, your focus will inevitably turn to your cost of goods sold, also referred to as your COGS. Suppose Sweet Scoops produces pints for a cost of $5 per pint. If Sweet Scoops produces 500 units, its variable cost will be $2,500. However, if Sweet Scoops doesn't produce any units, it won't have any variable costs. Now that we understand the difference between fixed costs and variable costs, let's discuss what these costs means for your business. The more fixed costs your company has, the more products you need to sell to break even, which means you need to work hard to produce and sell your products. This is because these costs occur regularly and rarely change over time. As you scale, your variable costs or costs of goods sold will decrease because you will be manufacturing more efficiently and ordering ingredients and packaging at larger quantities. This means you can leverage economies of scale and spend less per unit to produce. As your COGS decrease, your margins increase and you're able to pay off fixed costs faster. Let's look at another example. Suppose Sweet Scoops is in phase 4 scale. Because they're in thousands of stores, Sweet Scoops now has a continuous manufacturing system that makes their product easier and more efficient to produce. The production method decreases costs like ingredients, labor, and packaging, as Sweet Scoops is now manufacturing more ice cream in less time. Sweet Scoops has been able to leverage economies of scale by decreasing cost of goods sold through purchasing items like ingredients, product packaging, and case box packaging at larger quantities, as well as by increasing their production efficiency through mechanization. By leveraging economies of scale, they have been able to decrease their variable costs. The key takeaways from today's video are: a fixed cost is any expense that remains the same no matter how much your company produces. A variable cost is any expense that changes based on how much a company produces and sells. Understanding the difference between fixed costs and variable costs will allow you to effectively budget and plan for your business's future.